Jerome Powell, Mr. Fed Chair Jerome Powell, spoke today at Stanford University. I'm going to go over what he said, what he didn't say, and most importantly, the implications for what he is and isn't doing as a Fed Chair. And I'm going to explain it today in terms that a general user, a noob investor, a general person that isn't in finance can understand. I think that's going to be very valuable. So like, subscribe, stay tuned, turn notifications on to all so you get all my content. I'm going to break down all these tabs above here today, and I'm going to try and do it in a way that's going to really benefit everybody that listens. Share this video with people that might think it's very interesting, please, and let's grow this channel together. First and foremost, we got the ISM. The ISM, as I covered in my last video, I'll link it in the end of this video, was 48.2 versus 48.8 and 48.7 previously. It's not great, okay? So what does that mean? It means that business activity is not in a growth mode. It's in a conservative mode, conservation, cooling. And this aligns with the correlations that I'm seeing in the macro economy. This is the macro ghost here. We're going to get an interest rate cut. It's all but certain at 87%. So that's 25 bips down to 350 to 375 for the overnight rate of lending and borrowing for the banks. And here's what I wanted to talk about with Powell. Whenever Powell speaks, I'm going to probably go live and dissect what's going on. And this is my first show that I'm going to be doing that. And so the Federal Reserve has a duty to manage two characteristics of the market. They have two levers they can pull. The first characteristic is unemployment. They have to monitor unemployment. If unemployment gets too hot, they have to stimulate the economy so that we don't go into a super bad recession. And how do you stimulate the economy? Well, you can lower interest rates. That creates a borrowing opportunity for small and medium-sized businesses to borrow money at a cheap rate and grow their business with cheap money. Okay, and then the second duty they have is to control inflation. So as we all know, or most of us know, that the target rate is 2% inflation. What we might not know is that inflation is largely 35 to 40% shelter, housing, rents. 35 to 40%. That's a huge number. And it's a number that properly reflects the weight of somebody's budget. What does that mean? It means that if you make a $5,000 a month salary, you're probably going to be paying around 35% of that or less in rent if you're a renter. So the the government takes a sample size of 40,000 rental accommodations across the USA, Tennessee, New York, Florida, Chicago, LA, and they average it all together and to see where if there's inflation or deflation or stagnation in the rental market, and that lends to CPI. CPI, as we all know, and PCE, we'll just call it inflation, has been pretty hot, but it has been cooling down over the, I'd say, long term, which is 2 years. And what I wanted to dissect really is the largest component of inflation, which is rents. In this simple graph, so I break down the data here, but I graph it out, and that 2% is the target rate. And the rents, the actual rents are in blue. So as you can see from in basically the last 2 years, rents have come down to the target rate, okay? But CPI shelter, which measures rents, has not hit that mark yet. But as you can see, the correlation is nearly 1-to-1. So actual rents are at the 2% target, but the CPI shelter read, which includes not just rents, but other things, but it's coming down at a near 1-to-1 correlation. So we can project out into the future and say rents or CPI will be at that target rate, all things equal, okay? All things considering. And the reason why rents are coming down is because rates are so high. Landlords can't refinance. They can't borrow. They have to lower their rent to get a renter in there because the rental market is so competitive. So you'll see that. That's like a counterweight in finance, is that when rates are really high, the market's really restrictive, rents should come down. They should not be inflating when rates are very high. And Powell has said, he's reiterated a data-dependent stance on the economy. Well, that's nonsense to me because you have the data. You can, if I can forecast, me, some nobody on YouTube with 20 years experience, but some nobody, a Fed chair can also have the tools I have, plus hundreds and thousands of other advanced tools to say, we expect this to cool. Because the past is the past and rents are lagged. What that means is it takes a while for the rents to register in the CPI read. It takes about 6 to 18 months. That's why you're seeing that lagged effect of actual rents versus CPI shelter. And so what the facade he's giving out is kind of bullcrap to me. I'm calling it out. And he, his rate cut outlook, no explicit guidance on December. Well, the market sees right through that. The market expects a rate cut. But he has described it as not a foregone conclusion. And he also sees the labor market as being tight. But I'm calling that out as not true. Okay? I've modeled the labor data here, 25 versus 2024. The trailing 11 months. So I'm looking at the 11 months November versus the 11 months 2024 November. And I see unemployment ticking up in every single category except automotive, which is a small portion relatively. Government is from Doge, right? But look at tech, big one. Logistics, big one. Retail. And I expect, this is the most important thing as a federal governor. You have to expect the future. You can't just look at the past. You have to say, okay, ticking up, what's going to happen given AI? What's happening in AI? AI is displacing jobs in services, in financial services, in retail. It's all going to be run by Elon's bots. Warehouse logistics, AI, technology, AI. So are these jobs going to come back? Probably not. And they're not only not going to come back, but the layoffs in 2026 are going to be even more profound. You see what I'm getting at here, right? Higher layoffs, rents coming down. The market should be lowering rates more aggressively. As we looked at yesterday, the ISM is cool. I don't know why. I know I have theories on why. The why is that they're being very combative with Trump. They don't like Trump. Trump is just a businessman. He wants America to succeed. Whether you like him or not, he wants business. He wants low rates. He wants small and medium-sized entities to succeed. Okay? And the Fed, he doesn't portray that as his persona, but that's who he is. His persona is arrogant, is loud, is brash, and the half of America thinks that's rude, and half of America doesn't like that. And so I think half of the Fed is like half of America, right? And the other half of the Fed is, no, we need to see small and medium-sized entities compete and grow and borrow. And so that's just my opinion. And we look at Bitcoin here really quickly. We looked at it yesterday, same stuff. This is a new weekly print that we got today, so I'm going to cover that. But it's just basically bearish, okay, right? And we're going to have bounces. We're going to bounce to 94, or we're going to go back to 81 and bounce again. And the RSI is going to kind of figure itself out. But Bitcoin is in a bear market, and on crypto Twitter, people are like, I don't understand this. Why is crypto going down? Well, it's in a cycle, ladies and gentlemen. It's just a 4-year cycle. That's it. Stop making it hard. Humans make things hard. AI makes it easy. Stop making this hard. MicroStrategy, and MicroStrategy and Tom Lee, we don't understand. Everything is there. No, the market is always right. And the market says that Bitcoin is in a cycle. That's what it's saying. And the market is selling MicroStrategy off. So MicroStrategy holds 650,000 Bitcoin worth 55 billion, but its market cap is 45 billion. What does that mean? That means the market is expecting Bitcoin to fall. And if the market expects Bitcoin to fall, it tells me we are in a cycle. I'm just using logic. Pardon me if I'm not a perma bull. For the last 3 years, I was bullish and I had Bitcoin, right? So does that look bullish to you? It's as bad as here, and that's 2018. The worst, second worst quarter, fourth quarter in Bitcoin's history. Does that look bullish? No. So what I would do as a strategy, as my MicroStrategy, is I would be shorting or if you don't like to short, you can buy MSTZ, which is an ETF. It's an inverse MicroStrategy. And anytime greed and fear gets at 50 or near 50, I would just be buying MicroStrategy short, the MicroStrategy ETF. That's my plan. That's what I've been doing. I've been making money on it. So great for me. Copper looks great. I covered commodities yesterday, but I didn't cover one, and somebody mentioned it in the comments. I didn't cover this one. I forgot about it. VanEck Rare Earth Strategic Metals. This is rare earth, and also lithium is in there, and some companies. So I said I'd rather own the metals than the miners than the companies, but this is a scenario where I wouldn't. I like the rare earth companies in here. They have some China companies, have some US companies, and some Australian companies, and some other, not just rare earth, but lithium, AI. The company MP, the ticker's MP is in there. I like it. It's a metals and materials company. But look at the technicals, everybody. Shoulder, head, shoulder, over years, okay? Years. Shoulder, head, shoulder, and then what do we get? Look what we got here. We got a surprise for everyone. We get a volume breakout on the second shoulder. The volume breakout with an inverse head and shoulders is probably going to say we're going much higher. So I wanted to cover that. I wanted to give that away for free. Is REMX. We go down to the daily. As you can see, it's fulfilled that shoulder. That's the shoulder, and it's kind of pulled back. And so I love buying on these pullbacks. And so the second shoulder is in. And again, I wouldn't rely on this to be, moon tomorrow, but I would absolutely buy this as financial advice for the next 20 years. Because, my arrow is where we're going to go. And that's what I wanted to cover. I know I've gone a little bit long today, but I felt like that it is all value added. So I can't say it's the best content on the internet in under 10 minutes because it's probably over 10 minutes by now. But thank you for viewing, sharing this. If you stayed to the end, please share this with your friends that are interested. Don't share it with people that aren't interested. I don't care about them. But people that want to know about markets, macro markets in general, stocks, fixed income, commodities, currencies, crypto, fear and greed, Fed, macro, interest rates, policy, inflation, expectations. I cover it all, and it's going to be a great journey ahead of us. Volatility is great. That's what we love. So it's going to be a great journey, and I'll look forward to speaking with you guys in the next episode.